Most people spend their entire lives inside financial systems they barely understand. Not because they are unintelligent, not because they are careless, but because modern money is designed to feel ordinary before it feels overwhelming. That is what makes it dangerous. The pressure rarely arrives all at once. It builds slowly. A paycheck that feels smaller every year. Prices quietly rising. Monthly payments multiplying in the background. Interest growing while people sleep. Stress becoming so normal that nobody questions it anymore. And eventually, people begin surviving financially without ever truly understanding the systems controlling their lives. Imagine a young man named Ethan, 26 years old, working long shifts at a fast food restaurant outside Chicago. One Friday night, after another exhausting week, he finally receives his paycheck notification. For a brief moment, there's relief. Until he opens the app, the paycheck says he earned over $2,000. But the amount that actually reaches his account feels dramatically smaller. Taxes, retirement deductions, healthcare contributions, government programs he barely understands. Line after line. Tiny percentages quietly removing pieces of his labor before he ever touches it. And emotionally, that experience changes people over time, because most workers do not psychologically experience money through what they earn. They experience what survives after the system takes its portion first. That is the strange thing about modern economies. Money moves invisibly now. People tap cards, subscribe automatically, finance silently, transfer digitally. Entire financial systems operate quietly in the background, while emotional stress slowly builds in the foreground. Most people never physically see their money leave anymore, which makes financial pressure feel confusing instead of obvious. And taxes are only the beginning. Most people think banks simply protect money, like giant vaults filled with stacks of cash waiting safely behind metal doors. But modern banks operate very differently. The moment money enters the system, it begins moving. Your savings help fund mortgages, car loans, business lending, credit cards, investments. Banks survive because most people never withdraw all their money at once. The entire structure depends on trust, not visible money. Trust. And that realization makes many people uncomfortable. Because modern banking feels solid emotionally, even though most people never truly see how fragile confidence-based systems can become under pressure. This is why financial crises feel so psychologically shocking. Everything appears stable, until suddenly, it doesn't. One week, people feel secure. The next week, layoffs begin. Markets collapse. Borrowing becomes expensive. Savings lose value. Fear spreads faster than logic. And once fear enters financial systems, human behavior changes immediately. People stop spending, stop trusting, stop taking risks. Entire economies slow down because emotions slow down first. That emotional side of money is something schools almost never teach. People are taught how to work for money, but rarely taught how money quietly shapes behavior, especially through interest. Interest is one of the most powerful psychological forces in modern life. When people borrow money, interest slowly turns convenience into pressure. A small credit card balance becomes years of payments. A financed lifestyle quietly becomes long-term dependency. And because the damage happens gradually, most people adapt emotionally before they recognize the danger financially. But interest works differently for people who own assets instead of debt. That is where the system changes completely, because compound growth rewards patience in ways most human brains struggle to understand emotionally. At first, growth looks small, almost meaningless. Then time begins multiplying everything quietly in the background. And eventually, the people who stayed consistent begin pulling far ahead of the people chasing faster emotional rewards. That is why inflation feels so psychologically frustrating. People work harder, yet somehow feel financially weaker. Prices rise quietly, wages move slower, savings lose purchasing power. And most people cannot clearly identify why life suddenly feels heavier. They just know groceries cost more, rent feels harder, debt feels larger, stability feels further away. Inflation does not destroy people dramatically, it exhausts them gradually. And eventually, this creates a dangerous emotional cycle. People become so financially stressed that they stop making long-term decisions entirely. They focus only on surviving the month. That changes behavior more than people realize. Because survival thinking shrinks perspective, someone under constant financial pressure rarely thinks about investing, patience, future growth, compound returns. They think about immediate relief. And modern systems profit heavily from emotional short-term thinking. This is also why credit scores hold so much psychological power. They are not measuring character. They are measuring predictability. The financial system rewards people who behave in stable, expected patterns over long periods of time. Which creates a strange reality. Someone can look successful publicly while privately drowning in financial pressure. And someone else can look financially average while quietly building long-term security. The deeper truth underneath all of this is uncomfortable. Money itself is not really the goal. What people actually want is what money represents emotionally: safety, freedom, control, stability, breathing room, time. That is why people chase wealth so aggressively, not because they love numbers, because they want relief from uncertainty. And the strangest part is this: modern life constantly pushes people toward short-term emotional comfort, while real financial stability usually requires long-term emotional discipline. That conflict shapes almost every financial decision people make, because wealth is rarely built through dramatic moments. Usually it is built quietly: consistent investing, controlled spending, patience during uncertainty, time working silently in the background. Not exciting, not flashy, just steady behavior repeated for years. And that may be the most important financial lesson of all. Most people believe wealth comes from earning huge amounts of money. But often, it comes from understanding systems that other people emotionally react to without noticing. Interest, inflation, debt, time, behavior, psychology. The people who understand those forces early gain something far more valuable than income. They gain leverage over their future. Because in the end, money is not only math, it is emotion. And the people who learn how emotions shape financial behavior often change their lives long before their income changes at all. Entire lives inside financial systems they barely understand. Not because they are unintelligent, not because they are careless,